I should have sent an email about this. I grappled with this. The due date is going to be on the 9th of December, so the day after you have your last class, so the 9th of December, it can be at midnight. I'm fine with that, because by the 10th, I'm going to start looking to see if there's stuff missing. And I still need time to potentially contact people if I can't see something, because remember, sometimes you can see something on your e-portfolio and I can't. So the 9th of December at midnight, anything that is still due on the e-portfolio needs to be uploaded. And on the 10th, I'll start looking at e-portfolios and assigning grades. And there's still some grace period at that point that if I don't see something, I can still contact you in the hopes that you may be able to fix it by the following, or by that weekend or the following week. Does that make sense, Eric? I mean, no one likes deadlines,
Yes,
but hopefully,
thank you.
hopefully that. Thanks for reminding me. I don't know what's easiest. I could probably just, I'm not going to try to update this, but you know, the sheet that's been going for ages. But what I will do is this, I'll say due date for e-portfolio, okay? The final date to submit any missing portions of your e-portfolio work is Thursday, December 9 at 11:59 p.m. Now, obviously, I'm not going to be awake, or I hope I'm not awake at 11:59 p.m. It depends on what the baby's doing, but I'm not going to be looking at e-portfolios at 11:59. So, you know, it's not like there's some crazy cutoff where I'm just gonna, you know, I can't shut down your e-portfolio, but by about 9 o'clock the following morning, I will be looking to make sure that there's nothing missing. So you theoretically still, I mean, I shouldn't say this, but I'll say it, you theoretically still have some grace period between midnight on December the 9th and probably like 7 or 8 o'clock in the morning on December the 10th, okay, for those people who like to work in the middle of the night. So that's the due date for the e-portfolio. For anything that's missing, I'll be looking for it. You do have an opportunity today to work on anything, you know, that's happening that you still need to fix in your e-portfolio. You also have an opportunity on the 8th to do the same. So, you know, there's still time. The hope is that in those 2 hours, you'll be able to catch up whatever you need to catch up. I just want to remind people, there are 3 people in this class that I emailed who did not respond to me. I did not receive a term paper from you. You know who you are. I emailed you on Sunday. I also did not receive a response from you to the email I sent you about the term paper. I need you to react and make sure that you are talking to me about what's going on so that we can figure out what the way forward is. But if you decide that you're not submitting, that's fine, but I need to know that, because I will only be able to chase you for so long, and the term paper is a fairly hefty portion of your grade. So, you know, I want to make sure that you aren't. First of all, we need to confirm that you didn't send me something that is still stuck in your outbox, or that you know, that I just never received. And secondly, if you are planning to send something, it's incredibly late already. So we need to talk about that. Or if you're not planning to submit, that's fine, but then you just need to understand what the implications are, okay? So again, 3 people in the class, I've already emailed you. You need to get back to me. And if you are worried that you are one of those people and you don't know whether I received your work, you're happy to, I mean, I'll be happy to answer that question in the break. But I think those 3 people know who they are. All right. So like I said, I extended the homework to December the 3rd. For chapter 13, I'll have to probably maintain chapter 14's homework for the 8th. I may be able to push it to the 9th if it comes to that. But again, that's coming right up against the start of the finals. So I don't know, you know, what state people will be in, but I'm okay to be flexible on these last 2 homeworks, because it's getting really, for everybody, I think, getting a little bit nutty, trying to do everything that needs to get done, okay, including me. So any other questions about deadlines, about the end of the term year, or anything else before we go back into chapter 13?
I have just short question, Professor. In our final exam, is just test or quiz also?
There's no quiz. It's just going to be an exam with,
Okay.
there will be multiple choice questions, right, in the exam, but there's not going to be any not an additional quiz. The quizzes are done. Remember the quizzes are 2 quizzes at 3% each. So we're done with that. 6% term papers, 15% the portfolios, 10%. Okay. So that's that. All right.
Okay.
Any other questions, people? I'm just checking the chat here. Okay. I'm sorry, people are emailing me privately, so I just want to make sure that I'm responding. In the meantime, if you need to search for your term paper, whatever, look for it now. All right. So I'll go back into chapter 13, let me stuff off. Because it's really not part of the work. I'll take that off the front of the of our video. All right. So chapter 13 of current liabilities, we had left off on the contingent liabilities, and I just want to reiterate here that there are 3 scenarios for, or let me actually just take a step back. So contingent gains, you don't record, right? We had that whole scenario with me and Eric. We were in a very serious lawsuit. And so the gain that he's going to potentially get, he's not allowed to make a journal entry for it. He only discloses it in the footnotes, meaning he writes it up a little bit. If it's material, the amount is large enough to make a difference, and it's probable that he'll get it. The loss that I might suffer, I have to go through a thought process to see whether it is probable. Probable means that it's likely to occur, and whether the amount can be reasonably estimated. So if the amount is reasonably estimated and it's probable that I'll have to pay, I debit a lawsuit loss and I credit a lawsuit liability. And the wording of the question will give you this information. If it's reasonably possible that that I would lose, I don't make a journal entry, but I have to put the information in the footnotes. And then if it's remote sounds like it's very far away. It's highly unlikely that anything will happen. So I do nothing. All right. So the accrual is dependent on whether it's probable and reasonably estimated. And so we go to number 11 with Google Baby. Best name ever for a company, right? Consultants notified management of Google Baby products that a crib toy poses a potential health hazard, right? So you've seen this before. Sometimes there are even recalls of these products, of baby products, where people find out that the baby could get injured, and so there's the potential for lawsuits. Counsel is the lawyers, indicated that a product recall is probable. There's the wording that you're looking for, right? Probable, and it is estimated. There's it can be reasonably estimated to cost the company 5.5 million. There's the amount, right? So this falls right into that first category that we spoke about. The loss is probable and it can be reasonably estimated. How will this affect the company's income statement and balance sheet for this period? So here goes the class workings sheet. This is exercise 11. So it's probable, right? And can be reasonably estimated. So we need to record a journal entry for the contingent liability. And so how do we do that? we already said, right? We are going to, let's see, is it so much a lawsuit? I don't think that someone, yeah, it's probably just a loss. There's no lawsuit yet. It's probably just a recall. We'll call it a recall loss, for lack of any better term. And this is the recall liability. And it's a liability, contingent liability, because it hasn't actually happened yet. But we do need to make that, that provision in our books in case it does happen. Questions there? And so if it was already a lawsuit, right, then you would say lawsuit loss and lawsuit liability. But in this case, there's no lawsuit yet. The lawsuit may come after the fact, but we don't know of one yet. All right. So number 12 is an example of a contingent gain where we have to see, right, whether we need to record it or not. So Skill Hardware is the plaintiff in a $16 million lawsuit filed against the supplier. So plaintiff, I mean, they're using all legal terminology. Plaintiff means you're the person who is suing the supplier, right? You're saying, hey, something happened, I'm suing you, and I may get money from you. The litigation is in final appeal, and legal counsel, again, that's the lawyers, advises that it is virtually certain that Skill will win the lawsuit and be awarded $12 million. So this is an example of a contingent gain, right? And it says that it's virtually certain. So how should Skill account for this event? So if we go back, we know that you are not allowed to record a journal entry for contingent gain. It doesn't matter that it's virtually certain. That's besides the point, excuse me. So we basically, the most we can do over here is write in the footnotes that we are, anticipating a 12 million win, but you can only recognize the gain when it actually happens. Remember, we spoke about this notion of being conservative, right? Conservatism on the part of the FASB. So this is an example of a contingent gain, right? Skill cannot record the gain as it's not allowed, okay? And so we're just gonna say the gain is recorded when realized. Skill can disclose in the footnotes that they have a contingent gain. So no journal entry at all, which is, I guess, maybe for some companies somewhat unfortunate because they would have hoped that they could record the journal entry. So I'm going to throw it over to you guys. Unless does anybody have a question about this exercise 12? Okay. So number 24, you read this and see if you can figure out what needs to happen. This is also about contingencies, okay? Number 24, Scorsese. See if you can figure out. I'm going to give you from now until, let's say, 6 minutes, so, or let's say 11:05, okay? By 11:05, answer for part A and part B. And then I'll take someone, a volunteer. Joel, did you have a question? No? At 3 more minutes, and then I'll take a volunteer to tell us what to do. Right, so Embeddle, your hand is up. Do you want to answer the question?
Can I only answer A? The A will be the
Okay.
lawsuit law. I mean,
Okay, hang on. Let me.
lawsuit laws and lawsuit liabilities.
Okay, for how much?
900,000.
Okay. So in part A, we debit lawsuit loss and we credit lawsuit liability. And this is because it is probable, right? The language says that it is probable that there will be a loss and the amount can be estimated because we're told that the amount of the potential loss is 900,000. Thank you. So you said you only wanted to answer A. Did I hear you right?
Yes.
Okay, so Jaron, do you want to answer B? Because I saw your hand was up, or Madeline. Oh, sorry, Jaron, go ahead.
I think B is no entry because it's nothing here.
Okay, so no entry required, right? No journal entry because it is not probable. We don't have enough information. Sorry, enough information to know if disclosure, right, is required because they just say it's not probable. They don't say if it's reasonably possible or if it's remote, right? So A, you make a journal entry, right? It says prepare the journal entry. In B, you don't make a journal entry because it says that it's not probable. So probable and reasonably estimated are the two things that are going to be driving whether there's a journal entry or not. Hopefully everyone's okay with that, right? So is it probable and reasonably estimated? Journal entry. If it's possible, so reasonably possible, you only make a disclosure in the footnotes. So you write up in the footnotes that there's a lawsuit going on. If it's remote, you don't do anything. That's the end of the contingent liabilities. Embedded, do you still have a question or is your hand raised from before? Embedded, do you still have a question for me? Okay, I don't know what's happening. All right. So let's go into warranties and guarantees quickly. It's also part of contingent losses. And we're almost done with contingent losses, which means we're almost done with the chapter here. We've just got the warranties and then something really small to talk about, which is called unasserted claims. So I'm sure with all this buying of Black Friday and Cyber Monday and whatever else in between, that some of you maybe bought some electronics or something and you've seen, or in the past you've bought electronics and you've seen that there is a warranty or an extended warranty or something like that, right? That's on the item. Most of the time it's a manufacturer's warranty that says something like, you know, if this product breaks down within X amount of time, the manufacturer will fix it for you. And often the expense, depending on whether the product's still under warranty or not, the expense is the manufacturer's expense. You don't have to pay for the fixing. In fact, I didn't buy something like this over this weekend, but I do have a coffee machine that someone gave me as a gift, and unfortunately it has started to leak. And so I contacted the manufacturer and they said, excuse me, that they'll send me a box and that I put the coffee machine into the box and mail the box back to them. They'll fix the machine and they'll send it back to me free of charge. So obviously there is an expense related to it, but that expense they will have to deal with the expense on their side because they're not charging me. So what GAAP requires, right, what generally accepted accounting principles requires is that companies actually need to estimate at the time of selling these items how much they think they will have to spend in the future on fulfilling these warranties, right? So if you can think about it, right, let's say you sell coffee machines to the value of $1 million, but you know that, you know, some amount of those machines are going to need to be fixed. So maybe you say it's, you know, 1% or whatever the case may be. So you say it's, you know, $10,000 worth of fixing needs to happen. That's a liability that the company has to record at the time when they sell the machines, because you know what GAAP is saying is that, as usual, right, that you have to make sure that you are showing what is owed in the period when the transaction is happening, not having a surprise later on when suddenly you have to fulfill all these warranty requirements, but you didn't ever make a liability. So this contingent liability here, as you know, quality assurance, where this company says something like, we stand by our manufacturing, if anything goes wrong, you send it back to us. It's a contingent liability because whether the liability actually ends up needing to, I guess, be paid, or whether the work needs to be done, is contingent on something breaking. But because it's also part of a sale that has happened already, the amount some amount is required to be recorded at the time of sale, and that amount is based on previous experience most of the time. Sometimes you also, there's another approach that the book uses, but we're not really going to test this. It's called the estimated cash flow approach, where they kind of look at the best estimate of future cash flows related to the warranty. I did write it here, but we'll focus on this one, the manufacturer's quality assurance warranty. That means we're going to record some liability based on, some amount of a liability based on what has happened in the past. And so let me show you an example of this. It's number 20. And I know we're working out of order. Remember, I told you I just put down questions as good examples. I didn't really try to order them by topic. So forgive me, but I did put the entire solution for every question of this chapter in order, has been on Blackboard with the notes since we started this chapter. So you should be able to see everything in order there. All right, so let's look at number 20 together. This is the warranty question, and I'll work it through with you to make sure that everyone's okay with what this means. It sounds more complicated, or at least, well, I'm saying, right? It sounds more complicated than what it is. So, if it is complicated, I apologize for making that assumption. So number 20, Cupola Awning Corporation introduced a new line of commercial awnings in 2021 that carry a 2-year warranty against manufacturer's defects, right? So people can send stuff back up to 2 years after buying it. Based on the experience with previous product introductions, warranty costs are expected to approximate 3% of sales. So this is what I mean when we're talking about the manufacturer's warranty, that it's based on an estimate from past experience. So they're saying that 3% of whatever the sales are, that's probably the amount that they're going to end up spending, satisfying, the terms of this warranty when people send things back. Sales for the year and actual warranty expenditures for the first year are shown here. So the sales were 5 million total, and they've already spent 37,500 in 2021 fixing things that people sent back. All right, that's what all of this means. Does the situation represent a loss contingency? Why or why not? Right? So, if we just talk this through, I'll type it out for you, but if we just talk it through, right? What is a loss contingency? So there's some type of potential liability, or liability exists because something happened in the past, which is the selling of this item. And there's going to be a sacrifice of future benefits, right? Because they will have to fix these awnings if people send them back. So, and I guess the only thing that's outstanding is whether or not the awning breaks. So it's a contingent loss or a contingent liability, because we have a potential liability that is dependent on, a customer actually claiming under the warranty, right? So there's definitely a loss contingency for this. So I'll type over here, right? Yes. This represents a loss contingency because there is a potential sacrifice of future benefits, money, right, paid to fix the awnings due to a past event, which is the sale of the awnings, right? That depends on whether a customer claims or not. So if a customer claims, then you're going to have to pay. And is it probable? Yes, it's probable, right? I mean, I'm just adding on. Yes, it's probable because in the past there have been claims of at least 3%. That's what the question said, of sales, and the amount can be reasonably estimated. So I'm saying this because this means that we will have to make a journal entry. The fact that things like this have happened in the past means that it's probable that it's probably going to happen again. And we know that 3% is the amount that they said that they generally have had to pay. So there is a reasonable estimate as well. So this is all why and all of this is written out in the solution as well. So please, you don't have to scramble to write this down. If you can just listen and think about it, that's probably actually better. So this is a loss contingency. So now I think that was part one, right? They were asking in number one, or one, whether it's a loss contingency. And I believe number two is the journal entries to summarize the sales of the awnings, assume all credit sales and any aspect of the warranty that should be recorded during 2021. So this is very vague. They're trying to test to see whether you know what to record. So basically the sales, you're just going to debit accounts receivable and credit sales revenue for the 5 million. Then we have to record the 3% warranty liability that is probable and can be reasonably estimated. And then we also have to record the expenditures that we've already made related to those warranties. And I'll show you how to do all of that over here in number two. So the first thing is the sale, right? The sale of the awnings. That's where we start. So it said that it's all on credit. So we debit accounts receivable, right? With the 5 million. And we credit sales revenue. That's just a normal sale. That's not yet showing any warranty accounting. Now we're going to have the warranty liability that we will record, right? And so the debit for that is, it's easy to remember these accounts because it's all warranty, right? It's a warranty expense, and you're going to say 5 million multiplied by 3%. The 3% I'm getting from the question. It said that the warranty can be estimated at 3%. So 5 times 3%, 150,000. So this is the amount that the company has to record kind of in advance of anybody even claiming anything, because they can expect that people are probably going to send something back. And this is based on previous experience. 150,000. Questions up to you. All right. And then we have actual warranty expenses. And so that's coming from the question. It told us that 37,500 of expenses have been incurred for the year. Remember, it's all 2021. So you debit part of the liability because you're actually satisfying some portion of the liability, and you credit cash because you're going to have to pay out some money to fulfill those warranty costs. Right, so this liability is at the end of the year is no longer going to be 150,000. It's going to be somewhat less than that. I'll show you because I think that's the third requirement of this question. Asks us what's the liability at the end of the year. So I'll give you a minute here to, if you're taking down notes, to take down notes or to think about the journal entries and make sure you don't have questions for me. All right, so number 3 is going to be the warranty liability at December 31, 2021, right? That's what the question is asking. What amount should Capola report as a liability at December 31? So, I mean, this should be fairly easy, right? So warranty liability to begin with, right, is 150,000. Then it's expenditures, which will decrease the liability. 37,500. Oh, hang on. So ending balance. $112,500. So in the balance sheet, the company will still show a warranty liability related to these sales of 112,500. And that's how we account for warranties, right? So when you're buying your whatever Nintendo Switch, or you're buying your Vitamix blender, or you're buying your coffee machine or whatever, when it says that there's a warranty, do you want to, well, I'm not talking about the extended warranty that you pay for. I'm just talking about the regular warranty. Do you want to register your machine or register something with the manufacturer? I highly recommend that you do, because it will make claiming on the warranty much easier if you've actually registered your expensive electronics with the manufacturer. It shows the date of purchase and all of that, so that you can immediately see whether you're still under warranty. This also applies to phones. There's usually at least a one, I don't know if there's a 2-year warranty on phones. I guess it depends on the phone. Normally these phones are have built-in what do you call it, like I feel like there's a built-in deficiency where it will break after 2 or 3 years. So check if you bought a new phone over this weekend, if there's a warranty or something, make sure that you register your products with these manufacturers, because they're actually making provisions, right, for the fact that someone could claim. And so you need to make sure that you are able to claim when the time comes. Right? I was able to see my machine, because I registered it back in the day in 2019. I was able to see, when I bought my machine, what the serial number was and all of that stuff. So when I was trying to claim from the company, they could also see it, and they could see that I was still under warranty. I didn't have to scramble to speak to the person who bought the machine to try and find their receipt or whatever the case may be. All right. So that's warranties. If you're working at a company that does warranties and you end up accounting for them, this is kind of the process that you would have to go through. Does anybody have any final questions on warranties or contingent or the other contingent liabilities that we spoke about so far? All right. So the last thing to discuss here, and it's going to be very quick, is something called unasserted claims. This is also under the subsequent events we already discussed. So, don't worry about that. We discussed that this was when we're talking about whether something should be current or long-term, that even if a company has a December 31 year end, most of the time the financials are only being issued on March the 31st, and that things happen in between those two dates that may have to change the financial statements. Okay, that's what we mean by subsequent events. An event subsequent to year end, but before the financial statements are issued. An unasserted claim is when something is happening, something's brewing. Let's put it that way. Something's brewing. It hasn't taken place yet, and the company thinks there may be a claim against them, but that claim hasn't been made yet. All right. So they're kind of almost waiting to see what's going to happen. So sometimes companies are aware of a potential claim that has not yet been made. Such unasserted claims may require accrual or disclosure of a contingent liability. So the accounting goes so far, GAAP goes so far as to say, even though the person hasn't made a claim against you yet, if it's probable that there will be a claim, then you actually have to potentially record something. So a two-step process is involved in deciding how the unasserted claim, should be reported. Is it probable that a claim will be asserted? That's the first question, right? So if it's not probable that a claim will be asserted, you don't have to do anything. But if it's probable, then you have to move on to step 2. So you ask, do you think that this person's going to claim against me? Yes, it's probable. So the answer is yes. So if the answer is yes, treat the claim as if it has been asserted. So you have to see the likelihood of an unfavorable outcome, whether the dollar amount of loss can be estimated, just as you would do for a regular loss contingency. So, you have to really think about this in business. Do you think that that a company, I mean, realistically, is a company going to put a claim on their books that hasn't even been made by anybody yet? That's I think it's going to be rare for us to see something like that happen. I mean, unless it's like something that is so much in the public knowledge that they can't deny, that something's going to happen. But I mean, if there's something that the company knows about and they know that the claim hasn't been made yet, it would be kind of interesting for them to be putting a liability on their books related to a claim, probably from a lawsuit that hasn't even taken place yet, because they're basically saying to whoever could sue them, hey, we think you have a case, right? So, when you read these things, there's kind of the theory behind it that says that, this is what a company should do. And then practically you have to ask yourself, is this really what's going to happen? So when you guys are out there auditing or, dealing with, maybe you're the accountant, think carefully about whether, something like this exists, because it's not necessarily something that would maybe show up. Because it's kind of weird to tell someone ahead of time, like, hey, Jamie, I think you have a good case against me. I'm going to create a liability. And then Jamie's like, oh, hey, let me go to court and sue you. So a little bit weird. But again, if it's something that's very much in the public knowledge, then I guess, you kind of have to believe that there's probably going to be some type of lawsuit, and you have to make the journal entries for it. So what's the process? You ask, is it probable that this person will claim against me? If the answer is yes, then you treat it like a regular contingent loss, right? You ask, it probable? Can it be reasonably estimated? You make a journal entry. If it's not probable that the claim will be asserted, you don't have to do anything. And so we have this example here. Let me see, where's this? What's the number on it? Sorry, I've now lost my place, number 14. So here's an example of an unasserted claim. So let's see what happens. At March 13, 2022, the Securities Exchange Commission is in the process of investigating a possible securities law violation by Now Chemical. The SEC has not yet proposed a penalty assessment. So this is a little bit different scenario. And sorry, I can see how in this case it's possible that you probably could record something, because there's an investigation going and nothing has been claimed yet, but you have to see whether it's probable that some penalty will be assessed. NOW's fiscal year ends on December 31, 2021, right? And its financial statements are published March 2022. So this is a subsequent event, right? Because it's March 13, it's after the year end. But it's before the financial statements were issued. So now we have to see whether we have to make any changes to the financial statements. Management feels an assessment is reasonably possible. So that's not probable. So that means that we're done. The answer is no, there's nothing to record. And if an assessment is made, an unfavorable settlement of 13 million is probable. Now here they're trying to throw you off, because even though there's an amount that is probable, the fact that an assessment itself is not probable means that we don't have to put anything in the financial statement. So it says, what, if any, action should now take for its financial statement? So this gets confusing. It's a two-step process. The biggest step is it probable that there will be an assessment, right? And that they will assert a claim, and it's not, so you stop and you say there's nothing to record and nothing to disclose. Any questions before I type this up? Okay, so exercise 14, and we're gonna be done with this chapter, okay? Exercise 14, no journal entry and no disclosure required, because the assessment, which is the unasserted claim, is not probable. That's the answer. You don't care about anything else besides that, that it's not probable that the assessment will be made. So we're done. And we're also done with the chapter. So that's chapter 13. There's a lot going on. Remember, we started with current liabilities, and then we moved into contingent losses and contingent gains, lots of small topics. I'll remind you yet again that the solutions for all the questions are in order over here in a Word document. And of course, the solutions for the questions that we covered together are in the regular Google Doc. So let's take 10 minutes here until 11:42, at which point we'll start digging into chapter 14 for the time, that we do have until the person comes to do the assessment deposit in e-portfolio. Again, if you didn't hear me before, you need to please get your term paper ready for deposit. And I'm here during the break if people have questions. Go and enjoy your break.
Professor, question. Today we're gonna have a raise hour, right?
Yeah.
After, right?
Yeah. Yeah, 1
Okay.
o'clock. Mhm. All right, so that marks the end of the break. So the last chapter we have to deal with is 14. And remember, for the final exam, it's only going to be 12, 13, and whatever we get done in 14, that will be on the test. It's not all the work from before. That's, it would be too much. So please focus your attention on these last three chapters, so that you can make sure that you are ready for the exam. So chapter 14, so chapter 13 was the current liabilities, right? And the contingent liabilities. And then chapter 14 is all about long-term liabilities, bonds payable, which, we've run into before in our accounting curriculum, but obviously we'll deal with it, in depth now. Bonds, and then long-term notes. When we're talking about long-term notes, we're talking about things like installment notes, or even some other types of notes. It's basically just notes payable that forms the notes part of the chapter. So, we have just over 30 minutes before David joins us to do the upload work, and probably he won't take 30 minutes completely, but I'll see how far we get. In this chapter, we're going to do some stuff that may seem familiar to you. We had done in chapter 12 the investment side of bonds, right? When you invest in the debt of a company, so it's an asset for you. In this chapter, we will, and we had amortization tables and stuff, remember? But that was, the investment or asset side. In this chapter, we're going to look at the liability side. So there will also be amortization tables again. Fortunately, you've already done some of that before, so it shouldn't be completely foreign. So it's the amortization tables. There's also going to be some work with the present value tables to actually calculate the amount at which a bond is going to be issued. So if you are following along with me, you want to download the chapter 14 notes. That's what I'm looking at right now. Then In addition to that, and I will show this on the screen, but in case you want it for yourself, we will use the present value of an ordinary annuity to calculate the present value of interest payments. And we will also use the present value of $1 to calculate the present value of the bonds payable amount. Remember, those are the tables where you kind of just select an amount to use to multiply your amounts by. This is starting to sound like a lot of amounts, but I'll show you, okay? I'll show you how to do it. And so these are the two tables. We did use the present value of $1 table before, in a previous chapter, but it may or may not ring a bell because I think it was from chapter 10, so it could be that people don't remember it, and that's fine. So we'll go over it at length and make sure that everyone's okay with what's happening. So just to talk a little bit about the nature of long-term debt, companies often have to get money from somewhere. I mean, if you've ever watched Shark Tank or something like that, you can see that, when someone has a good idea, the investors will say something like, I'll give you 500,000 for 10% of the company. Or, if you see IPOs that are happening, like companies are going public, that's also equity, just like the Shark Tank thing is equity. Right now, we're talking about how companies could, raise money through debt, right? So they issue debt. And obviously, a massive difference between equity financing and debt financing is that the debt, like a bond, you will have to pay back. Whereas equity, people are giving you money, but they're not expecting you to pay them back. They're hoping that the stock price or the business will just become so valuable that they'll be able to make so much more than they put in. Of course, with debt, one of the limitations is you have a very specific amount of return that you're going to get, and you also, will get your money back, but your returns are limited. Whereas with stocks, of course, the stock price could go sky high, and there's no limit on how high it could go. But the risk with the stock is also that the price could fall and you could lose what you put in. So liabilities, when you look at the assets of a company, you always think that the assets are financed either through equity, someone put money in, or debt, the company borrowed money, right? So the liabilities indicate how much of the company's assets are, related to borrowers, their interest in the company. And like I said, in chapter 12, we already looked at the investment side. So the investor that buys the bonds payable from the company, they have an investment in debt. And we went through all of that, right? They have interest revenue, they receive cash. There was potentially sometimes there are discounts, on the investment and so on. But now again, change your mindset into the liability mindset, where we are the company now and we've issued a bond payable or a note payable and we owe the money. Right. And so we know this about a liability already, but we'll just go through it. A liability requires some future payment of cash, right, in estimated or specified amounts. There's going to be periodic interest that's usually calculated as the effective interest rate, which we'll talk about some more, times the amount of debt outstanding. Effective interest rate is sometimes also referred to as yield. Yield is a word we also ran into in chapter 12. So effective interest rate is what you are actually earning or actually paying on the debt versus the stated interest rate, which is, the contractual amount. As soon as debt is issued at a premium or a discount, then the stated rate and the effective rate are going to be different from each other. And because of the time that lapses between when we issue this liability and when we pay it off and so on, the long-term liabilities are generally going to be shown at present value. This is also why we're going to be using these present value tables. And present value just means what is the value today, right, of all those cash flows that are going to happen in the future. So what's the value today of all the interest payments on the bonds payable? What is the value today of the bond payable that will be repaid in the future, right? So we will calculate present values together, and I'll show you how to do that using the table. Any questions or comments at this point? Okay, so I hope that by now you see that there is some, it's almost like the mirror image, right? The other side of, or the other side of the coin, as the book also refers to it, that the investment in debt that we did before in chapter 12 is related to the bond payable that we will deal with now in chapter 14. Okay, it's the other side of the same transaction. So in the first part here, we talk about issuing bonds, right? Bonds payable. So, you know, some companies may choose not to borrow from a bank and instead issue bonds to the public and maybe even to other corporations, because they can split out that big debt. Like, let's say they want to borrow $50 million, instead of going to Citibank and saying, hey, can I borrow $50 million? And Citibank's like, you know, we'll have to think about it. They can maybe break up that $50 million into 50 bonds at $1 million each, or 500 bonds, you know, at 100,000 each, or whatever the case may be. They can break a large debt up into smaller pieces and borrow from multiple lenders. So that's some of the benefits, right, of a bond payable. And of course, they'll have to pay back the amount whenever the bond matures, right? That's the language, maturity date. And they also have to pay interest to the lenders between the date that the bond is issued and maturity. And so that amount that they pay is the stated percentage. So if we say it's a $50 million bond with a 10% interest rate, they have to send their lenders 10% of 50 million, right, as interest in cash. But the amount that they record as interest expense is potentially different from the actual cash that is sent out. So, you know, the interest rate, the contractual interest rate on a bond is sometimes referred to as the stated rate, the coupon rate, or the nominal rate. All of those things mean the same thing. It's just the interest rate that the company agreed to pay to their lenders, the investors in their bond. We'll see a lot in our examples that the interest is paid semi-annually, so every 6 months. So any rate that is stated, we will have to divide by 2, because any interest rate is usually quoted as an annual rate, but we are doing semi-annual payments, so it's only half of that amount of interest that would be paid at every interest payment date. And, you know, the book goes on a bit about different types of bonds, secured bonds and callable bonds and so on. I'm not too concerned with those, in the sense that, yes, those are features that bonds can have. We're much more concerned with making sure that we can actually do the journalizing of, you know, the bond issuance and so on, because the features of the bond are not going to change for the most part how it's journalized. There's only one type of bond that has a detachable warrant that is, you know, something that may be slightly different, but we'll deal with that later. Okay, so what are we focusing on? Do we know how to calculate the amount at which a bond will be issued? Do we know how to make the journal entry for the bond payable that is issued? Can we calculate interest on that bond and make the journal entry to record the interest payment and the interest accrual? Those are the types of things that are happening, okay, in this chapter. So again, I mean, I don't know that you guys would remember this maybe, but in Principles of Accounting 2, there's a whole chapter on long-term liabilities, and there was all the work on bonds payable. And I know that in Intermediate Accounting 1, you guys did some work on present value as well, and the balance sheet and so on. So perhaps some of these things are, you know, ringing a bell. So how do bonds get issued? Either at face value, which means the amount that will be paid back in the end is the same amount that we are getting, you know, at the beginning. That's face value. So if it says that it's a $50 million bond and we receive $50 million cash, we issued the bond at face value. And that's normally face value. the bond is issued at face value when the stated rate of the bond, so the interest that the bond pays, is the same as the interest that the market, and by the market, I mean everybody who is investing, it's the same amount that the market is demanding. So let's say the stated interest rate is 5% on the bond, and 5% is generally what the market is also asking for. The bond will be issued at face value, right? The bond could also be issued at a discount. A discount means that we basically had to decrease the amount that we receive for the bond lower than face value because we're trying to attract people, right, to invest. And so the discount is over here. A discount will happen is if, let's say the stated rate of the bond is 5%, but the market is demanding 6%. And so the company doesn't want to change how much interest they're paying. They're keeping it at 5%, but they're willing to receive less cash for the bond on day one to try and basically put the bond on sale, right? So they say, okay, this is a $50 million bond. We're willing to take $49 million today because we understand that you want 6% interest, but we can only give you 5%. So we have to sweeten the deal, right, as the language goes. So over here, right, example, stated rate, 5%, market rate, oops, not this, sorry, 5%, market rate, 6%. So the bond is going to be issued at a discount, right? And then there's a premium. And so the premium is just the opposite, right? That the bond is paying such a big amount of interest that everybody wants it because it's paying more than what the market is returning. And so because everybody wants it, there's such high demand, so the company can actually push the price of the bond up, and the bond will be issued for more than face value. So here the example is that, let's say the stated rate is 8% and the market rate is 7%. I'm just making up numbers, right? So the bond issued for more than face value. And here I'll just be very clear that the bond issued for less than face value. That's the I guess the thinking around bonds at face, bonds at a premium, and bonds at a discount. And we'll deal with most of these scenarios as we go through examples, and we'll do one example fairly soon. I just want to make sure that people are okay with these three types of issuances. I'll let you think about it for a few seconds and ask me any questions you may have. Read it, think about it. Let me know if there's any questions. Okay. So what we'll do next, and this will be the first two examples, they're fairly short, but they're a little bit involved. What we'll do next is actually calculate the present value of a bond to see at what amount a bond will be issued. So here's some theory around how that amount is calculated. The bond price is calculated as the present value of all the cash flows required of the bond, where the discount rate, and discount rate means the interest rate that we will use in the present value calculation, is the market rate. Specifically, the price will be the present value of periodic cash interest payments, so all the interest that is going to be paid, plus the present value of the principal, so the actual bond amount that is paid back at maturity, both discounted at the market rate. And this last part is just about if there are any debt issuance costs that are included anywhere. We don't have examples of that, but just so you know, it's treated as a bond discount. So if a company issues bonds and they have some costs around it, like let's say underwriters cost or something, is treated as a discount. Let's just focus our attention here though. How do we calculate the present value of a bond? We calculate the interest amount, right? We figure out what's the face value that has to be paid back, and then we present value all those payments back to today and see the amount that we come up with. Okay, that's how we'll do it. And so then I guess without further ado, let me show you how to do it so it doesn't have to seem so mysterious. So on the same handout, we have examples for chapter 14. I've taken them from, they're from the textbook, and the homework will mirror these examples. I do have all the solutions. I haven't put them up yet because I just want to make sure that people are, paying attention even a little bit to what we're saying and not just looking at the answer. So let's look at this. A company issued 5%, so that's the stated rate, right? That's the actual interest rate for the bonds, 5%, 20-year bonds. So it's, that's the term, the time to maturity, with a face amount. That's what's going to be paid back at the end, right? The maturity amount of 80 million. The market yield, so this is the market rate for bonds of similar risk and maturity, is 6%. So based on what we just discussed about premiums and discounts, do you think this bond, you can tell me in the chat, is this bond going to end up being issued at a premium, or let's say at face value, at a premium, or at a discount? Tell me in the chat. Based on what we discussed between the stated interest rate of the bond and the market rate, will this bond be issued at face value, at a premium, or at a discount? You're welcome to guess if you want to. Yes, Xiao Yi, it's a discount. Okay, Xiao Yi is saying it's going to be at a discount. And why is it at a discount? Do you want to tell us, or do you want me to tell us? Why is it at a discount? I take it from your silence that you want me to tell us, right? Okay, so it's at a discount because the bond is only returning 5% and the market is demanding 6%. So the market wants more interest than what the bond is giving, right? But that's what the bond is giving. So the company has to make the price of the bond when they issue the bond less so that they can get people to invest, right? It's almost like for, I guess, Black Friday or whatever, when you were shopping, you saw all these clothes and things at a discount, right? A discount is given as an incentive for people to buy stuff. It's the same here with this bond because the company is not paying the same as what the market is asking for. So they'll have to make the price of this bond lower. So we already know before we've even done the calculation that the amount that we will come out with for the present value of this bond is going to be less than $80 million. All right. And if you can't remember why this is the case, go back here and check, right? When the stated rate is less than the market rate, the bond is issued at a discount. Okay, so let me go into the solution page here and we'll do exercise 1. So this is how you do it. We haven't done something like this before, so I'm going to go slow. We need to figure out how much is the interest. We need to figure out how much is the principal, right? And so we're going to, find the amount. Then we will have to find the present, what we call the present value factor that we will use. This is from the table. Oops, from the table. Okay, and then you will calculate the actual present value of, and you don't have to set up this thing, like, I'm just doing this because I guess this is how my brain works, but I just want to make sure that everyone understands which inputs have to go into present value. This number over here is what we want. Okay, we don't know what that number is going to be yet. So we do, however, know for the principal, right, that principal is the same as face value. Apparently gone back now either. Face value, right? So we know that that's 80 million, right? 80 million. And the present value factor that we have to use to try and calculate how much is 80 million that's going to be paid in 20 years, how much is it worth? Sorry, how much is it worth today? Let's first go back here because I realize there's something I need to discuss. Interest is paid semi-annually, right? So twice a year. This is an important point because this tells you how many periods you have to use for the present valuing of these amounts. Because interest is paid semi-annually, that means that for 20 years, there will be 40, right? 40 payments. And so we need to make sure that we take that into consideration. And then also the interest is 6% for a whole year, but it's going to be 3% per period. I'll repeat. The bond is around for 20 years, but because interest is payable semi-annually, we need to say 20 times 2. That means there's 40 periods that we will be working with. Interest is being paid 40 times. And then also the 6% is for a whole year, but since we have 2 payments per year, it will be 3%. And this 5% is also for a whole year. So since we have 2 payments, it's going to be 2.5%. I'll show you how to use all of those numbers. So for the 80,000, right, for the present value factor, let's just do this. What are we doing, right? It's the present value of $1. Let me put this star here so you know that I'm talking about this one. It's going to be the present value of $1. That's the sheet that you're using. N is the number of periods, right? The number of periods that are in this present value in calculation. And that's going to be 40, right? It's 20 years times 2. So we'll use N as 40. This is what all the stuff that you need for the present valuing. And then the interest is, since we have to use the market, remember we have to use the market rate. It said that in the theory that you discount using the market rate. It's going to be 3% because it's going to be 6% divided by 2. Questions there before I look at the table? So I'm going to the present value of $1 table, and I'm going to look for 40 periods and 3%. This is how the table looks. It's at the end of the textbook, but I just put it up for us anyway on Blackboard. So N is 40 over here at the bottom, right? 3% is over here. So I'm going to go down the line until I get to 40. So 40 and 3% is this 0.30656. It looks like 0.30656. Hopefully everybody sees that. 40 periods because it's 20 years, but it's semi-annual. So I'm using the number of periods that relate to this bond. And then 3% because it's half of 6%, right? How many times are we paying out? So you may be confused, or I don't know if it's confusing. You could say, well, the the principal amount, the face value is not being paid out 40 times, right? But because the interest is as a time period of 40, we also have to use 40 for the principal amount. So we bring back the present value factor over here, and it's 0.30656. And so now we know that the present value of 80,000, not 80,000, 80 million, sorry, in 20 years is going to be this 24,524,000. So that's interesting, right? It's much lower than what you would maybe think. So we're simply using the table. Questions on that? Okay. So to do the interest, I'm going to ask how much is the semi-annual interest payment, right? I need to know how much that is. So interest is 80 million times 5%, but it's only at 6 months, every 6 months, times 6/12 or divided by 2. If you do the math on that, it's going to come out to 2 million, right? Because 80 million times 5% is 4 million, divided by 2 is 2 million. So our interest amount every 6 months is 2 million. And we still need to figure out what is the present value factor on that. So,
Professor,
yeah,
can I ask you, sorry, why did you, how did you find that 40? Why did you multiple the 3
sure.
years by 2?
Yeah, so it's because over here, do you see that it's a 20-year bond, but it's semi-annual interest? So because the interest is being paid every twice a year for 20 years, it's 40. Because we're doing the interest for 40 periods, we also do the principal amount for 40 periods.
I see. Thank you.
No problem. Anybody else questions? This is not easy, people. Don't feel bad if you're taking a while to figure this out. It's brand new, and I mean I have more examples, so don't panic. On next week Monday we'll do more. I just want to make sure that I'm going super slow on this first one, hopefully slow enough for people to follow. So the interest is what we call an annuity. An annuity, I'll just write it here. An annuity is a payment that happens, right, once per period, whatever that period may be. So it's like an interest payment in this case, right? In this case, once every 6 months. That's what an annuity is. So when we look at the interest, we're going to say the present value of an annuity, not of $1, but the present value of an annuity with the same information as before, right? We still have N, which you know by now is the number of periods. N is 40. And the interest rate or the discount rate is also going to be 3%. We use the market rate, not the stated rate, right? Use the market rate, not stated rate, unless it's the same. So we're looking for the present value of an annuity for 40 periods with a 3% interest rate. That's so that the interest will always be an annuity, okay? The principal will always just be the present value of $1. And so interest, present value of an ordinary annuity, not an annuity due. I don't know if this is the same in the 10th edition, but for some reason in the previous edition, when I took this page out, it says that it's future value, but that's actually a typo, because when you look here, you see that it is the present value of an ordinary annuity. So we're looking for the present value of an ordinary annuity at 3% for 40 periods. So when we go across, we see that this is the answer, 23.11477. I repeat, present value of an ordinary annuity for interest for 40 periods at 3% discount rate, 23.11477. So that is the present value factor that I have to use, 23.11477. And so I multiply that 2 million by the present value factor, and this is now the amount that all those payments will be worth. So you can see that 2 million received 40 times over 20 years is worth 46 million today. Questions on the present value of an annuity? And so we're almost done because we're going to do our e-portfolio here in a second. I see David is on, so that's good. So now all we do is we add together the interest present value and the principal present value, and we come out to $70,754,340. This is the present value, which is also the same as the price of, of the bonds. So if they're asking what's the price of the bonds, it's this, 77.54. So remember at the start, we said that the bond would be issued at a discount because the stated rate of 5% is less than the market rate of 6%. And you can see that now the bond has a face value of 80 million, but the price that the company will be able to sell it at is only 70 million because they are paying less interest on the bond than what the market is demanding. Let it simmer. Does anybody have questions? It's a little bit wild, the stuff, right? So think about it. On Monday, we'll just continue, and I'll just go over this again, and then we'll do another one until we're kind of okay with how to use the present value tables and why we use the ones that we do. Okay. I think maybe the silence means that people are shell-shocked, right? I don't know. Okay, so without further ado, then remember I told you that someone was coming to help us to upload term papers into the assessment area. Jaron, you've already done this, so you know, you can observe if you want to, but you're also done, so you're welcome to move on, to leave if you want to, because we're not going to do anything else for work after this is after this demonstration. So I want to welcome David. David Brandt is here to help everybody. He's going to demonstrate for you how to upload your term paper. So just like I said before, please have your term paper ready, the correct version of your term paper, right? If you have multiple versions, please stop and check to make sure that you are doing the right version. And then please go in, if you haven't already, into ePortfolio, into Digication to be ready for the demo. And so, David, if it's okay with you, I'll just hand over to you. I did make you a co-host. I'll stop my share.
Oh, sure.
And you're welcome to, if you want to share your screen, or if there's stuff you want to tell them before we start that, the floor is yours.
Yep. Thank you, Professor Francis. Hi, everyone. I'm David Brandt. I work with LaGuardia Center for Teaching and Learning, and I'm not going to be talking about accounting or bonds or anything like that, because that is way out of my area. But I'm going to guide you through, as Professor Francis was saying, through the assessment depositing process for your final term paper for the course. So as Professor Francis was saying, if you could all log into ePortfolio, that would be great, because we will need to do that for this. I know some folks like to go through their My LaGuardia page and some go through the Digication website. So I'm just going to put a direct link on the chat for you all to be able to do that. I'm gonna go ahead now and share my screen. Can you all see my screen? Okay. Yeah. Okay, good. It's been kind of finicky though. I think it's because I have two monitors in my office, so it gets kind of jumbled sometimes. So okay. So once you get onto that page, right, please go ahead and log into your ePortfolio, okay, or Digication account rather. So I said, I mistakenly said ePortfolio to log into ePortfolio when in fact it's actually Digication. And I'm making this distinction because there's two components to this platform, right? So the one that you are most likely the most familiar with is ePortfolio, right? Because that's where you have your electronic portfolio that you created in the first year seminar that you've continued to use throughout your time at LaGuardia, including now, right, as I imagine that some of you are approaching your graduation, being that you're in this capstone course. And if you are, then congratulations, that's awesome. But this is something that you've used throughout your time at the college, right? So that's one component of this. The other component is called the CMS, so course management system. So what this piece serves as, excuse me, is sort of like Blackboard, right? I think everyone in here has probably developed some familiarity with Blackboard, probably over the last year and a half more familiarity than you'd like to have. But Digication functions in a way that's very similar to Blackboard in the sense that it has certain settings features like announcements and group emails. But another thing it has is the assessment area. And that's what I'm going to be doing with you all today. So if you see my screen here, right, you'll see towards the bottom of the page, you have this area called courses, assessment groups, and communities. You should have a course here that says BTA 202-0035. Is everyone seeing that on their end?
Yeah.
Yeah. Okay, awesome. So I want you to go ahead and click on that. And throughout this process, if I'm doing anything too fast or if I'm talking too quickly and you want me to, like, you know, repeat something or slow down, like, please let me know. Because this isn't going to take too long. So we have time for me to show it again if need be. Okay, so I want you all to click on that course that says BTA 202. Once you click on that, you should be on a page that looks kind of like this. And I say kind of because you won't necessarily have all of these tabs up here on the top. Some of these are just for like the faculty or staff on the course, but you will have the one that says assessment. Okay. So take a moment to click on that BTA 202 course. I'll show it one more time. On your homepage, you're going to scroll down to the bottom, and then under course, assessment group, and community, you'll see BTA 202. If you don't, maybe you're taking like a lot of classes, so it's not necessarily displaying all of them. So if it's not popping up immediately, you can just type in BTA 202 in that little search field there, and it'll come up. Okay, so once you get onto this page, like I had mentioned, there's going to be a few options on the top, which you won't necessarily have all of, but you will have this tab here that says assessment. And I want you to go ahead and click on that assessment tab. Okay, so this is my view, right? But I'm going to click on one of your names. I'm going to pick someone at random. I don't know, Eric. So this is what you'll see after you click on that assessment tab. You're going to see your individual area. I just saw the list of names because I have the staff access, but in your case, as a student in the course, you're going to see your individual name. And you're depositing the assignment here because the assignment that you're depositing, what's being assessed here, so the institution, right, to kind of learn from the student experience and learn about how you're learning, basically, right? LaGuardia aims to graduate students that are proficient in different core competencies and communication abilities, right? So this assignment is assessing your inquiry and problem solving skills as the competency, and then it's assessing your written communication ability, right? And both of these things are exhibited in the assignment in your term paper, right?
And just if I could add, and
Yeah.
you've explained it very articulately, and just so that people don't panic, this is basically just the school making sure that we said that we did what we said we were going to do in the class. No one else is grading your work. I am still grading your work, and I will return a grade to you. This is just a deposit so that the college can look at the work if they want to, or they can just make sure that we actually did do the work in the class. Okay, so don't expect that there's going to be a grade that's going to pop out from somewhere because of this deposit. This is just a deposit to make sure that the college can see that we've actually accomplished what we hope to accomplish.
Yes, thank you, Professor Francis. That's absolutely right. And this always, whenever I do this with students, people always ask, well, what am I being graded again? No, it's just an institutional thing. So it's not, no one else is looking at this other than Professor Francis. Well, no, I mean, sorry, no one is grading it, excuse me. Okay, so I want you to click on here where it says step 1, student submission. Are we all here, or do we need another second? Okay, so I take it as I'm good to go and proceed. So I'm going to click on where it says step 1, student submission. So in this area, there's a couple different ways that you could add the assignment, right? So you can upload it as a file. You could choose it directly from a page on your portfolio, or you can copy and paste in the rich text, which I've never actually seen done ever, and would probably look weird and be very messy with formatting. But for the purposes of our time together right now, we're going to keep it real simple, and you're just going to upload the file.
David, I forgot about this piece. Do they need to remove their names, or it doesn't matter anymore? I can't remember what the.
Yeah. So I was gonna mention when it came up about the idea of this being a, not graded. So to the point of what Professor Francis was saying, if you want, you can remove your name from this, because this is not assessing you as the student, it's assessing your work. If you already finalized your assignment and it's done, you don't have to, but I did want to present that as an option.
Yeah, so what he means is if because remember, I always ask you guys to put your name on every sheet so that if I print out your work, I know whose work it is. If you want to take your name off for any reason, you're welcome to do that. If you don't want to take your name off, that's also fine. It doesn't matter. You're not going to be traced or anything like that. It's just that if you really don't want your name on this thing when it's going into the system, you're welcome to take it off. So then take a moment, adjust your document, take your name off. Take your name off the name of the document also if you have it there, and then you can upload it. And we'll give you some time to do that, right? We can probably take like 3 minutes for people to just get their files in order and then upload.
Yeah, absolutely. Because from here, it's pretty straightforward. I mean, for anyone that's ever sent an email with an attachment, this is really no different than doing that. So essentially, what you're going to do, and I'll show this again, is under upload files, how it says browse here, you're going to select that button, and then that will allow you to attach a file from your computer. So in my case, I made a little sample document for our purposes today. And I would select that. Oh, that's odd. Give me one sec. Oh, there it is. Okay, sorry. I did it twice. Okay, interesting. Okay, well, I attached it. You see how to do it. So again, it's just add file and select browse, and then you could pick it off your desktop or wherever it is, flash drive, wherever you saved it.
and we need to see that it says that it's there under evidence added. Is that what they need
Yes.
to look for? Okay.
Yeah, so once you've uploaded it successfully, you'll see it there under evidence added. And just to make sure, if you want to be super safe and just check to be like, okay, did I put the right thing? Did it process okay? You can click on it. And then it downloaded this, which is the little sample document that I made. I just put a bunch of sample dummy text like you have on your portfolio. So that's a way that you could just sort of check your work before you've confirmed the assessment deposit. Yeah. Eric?
Can I ask,
Yeah, I think you put it under mine or what? Because I can see that.
Yeah, I did. So
uploaded-
I'm trying to delete it.
Yeah, because I just uploaded the term paper and then there's like 2 documents under there.
Yeah, he's gonna delete it. Can you
Yeah.
delete it from Eric? You
Yeah.
were the sample student, Eric. and
Yeah,
now-
yeah, yeah.
Now we've caused some commotion for you. Just bear with us.
Yeah, it'll just take a moment.
can I ask you?
Go
Give
ahead,
me
go ahead.
one
Oh,
sec.
yeah, so
Uh,
not any changed. I just upload.
Yeah,
should
you
I-
don't have to change your document, Marina. No changes needed. If you want to take off your name, you can, but please don't adjust anything. This is the same document that you sent to me. Mhm.
The name is a option.
Yeah,
Up to me.
optional.
Okay.
Mhm,
Yes.
mhm.
Thank you.
And Eric, I just fixed it, so you're good now. I see that you completed the
We
deposit.
can't see your
Okay, thank
screen
you.
anymore. I don't know if we need to, David, but.
No, I was
Okay.
stopping the sharing just while I was fixing Eric's deposit. Would anyone like me to show this again?
Does anybody need additional demoing? Do you need David to show again with someone else? I mean, David, you can probably see in your view already whether people are
Yes, I
uploading.
can.
I know I can as well. I'll just
Yeah.
refresh. So
Yeah.
guys, we can actually see what you're doing. So there's, people who still need to upload, who haven't uploaded yet. Please go ahead and do that. And if you have problems with uploading, let us know. We're still gonna stick around until the end of class
Mhm.
at 12:45, and at that point, check again to see if there's anybody who still hasn't uploaded. There are a few people who still have to actually submit the paper, so I think there's like 4
Mhm.
people who.
Okay.
So minus the 4, everybody else who's in the class, because there may also be people who are absent. Let me check here.
Right,
Yeah, there's
so-
there's one person who's excused today.
Okay.
So there's 5 that we
Fine.
wouldn't expect, but the rest we expect.
Okay. Yeah, so we have 6 up on there right now.
Okay, so we're still waiting then.
Mhm. Yeah, and the one thing I realize I neglected to mention now in the beginning is that if you, I don't know if you're using a Mac at home, if anyone has a Mac, but if you do, don't use Safari for this. Digication, the main platform that hosts ePortfolio in this, course management area, it doesn't work with Safari. But sometimes it's just finicky, but the assessment area has a lot of trouble with Safari. So if you have a Mac, make sure to use Chrome or Firefox. And the same thing for PC owners, don't use Internet Explorer or anything, use Chrome or Firefox. I don't know if people still use that, but I always put it out there as a announcement.
So if you're stuck because you're using Safari, get out of Safari. That's really the bottom line, and get into Chrome or Firefox, okay?
So I'm going to go ahead and briefly demo this one more time from the beginning. And I see that the session is being recorded as well. So I imagine you can always refer back to this too. But I will share at the conclusion of our session some resources that could be helpful. So on my homepage, right, I'm going to go to BTA 202. And then I'm going to have those tabs on the top of the page that offer me, different options. And I'm going to select the one that says assessment.
Are you demoing? Because I can't see your screen. I
Oh,
didn't
I'm
hear what
sorry.
you
Oh
said.
my God.
Sorry.
Let me go
Sorry.
back.
No, I was also distracted.
No, that's okay. Good. Thank you for telling me. Can you see it now? Okay, great. So let me do this again. So you're going to select BTA 202 from your Digication homepage. In the event that you're like stuck on another page or somewhere and you don't know how to get back to home, you'll see up here, there's a home button. But then whenever you want to go home in general to like the home navigation on Digication, if you select the D in the upper left-hand corner, you can just click on the little icon that says home, and that'll take you to the home page. From there, again, select BTA 202. You're going to select the tab on the top of the screen that says assessment. And then I'm going to pick a new sample person. So I'm going to pretend I'm Christopher here. And then you should be on a page that looks like this that says inquiry and problem solving written, and then step 1 student submission. You're going to select step 1 student submission. And I see that the file is already in there. So the last thing to do when you add that paper is to click on the green button on the bottom that says complete and submit. Don't click save, do not submit. This is usually for deposits that consist of multiple assignments, but your deposit is really simple and straightforward. It's just that one paper that you wrote. So once you upload that paper, you're going to select complete and submit. And then in terms of adding the file, I'm not going to add it like completely because I see that Christopher already put his paper in, so I don't want to mess it up. But you would just select browse. And then from there, you can find the file from your Word document. I'm not sure what the final paper is. Is it a PDF or a Word document? I'm not sure about the formatting that this class did, but either one, it doesn't, it takes any kind of.
It's either or, it can be, they did Word or PDF is also fine.
Okay, yeah, so it'll take either. Okay, but just don't forget to click complete and submit, because even if you add your paper there, it's still going to show up on the faculty staff end as not completed. So just make sure that you click that button on the bottom, and then once you do that, then you're good. That's it. Okay, so I'll give folks another minute to finish that off, and then I'll put a couple of resources in the chat that might be helpful.
There are some people who are on this call who have submitted a term paper and who have not yet submitted the assessment deposit. I'm not sure if that's because you're on the call in name only or what's going on. But if you're there, hello, please submit your term paper so you can get this over with. I'm seeing some names here that are clearly present, but it's not happening. And if you're having some type of technical issue, speak up so we can help you. All right. We're here to help. So, I'm not going to call people's names out. I don't want to be that guy or that person, but there are some folks who are present on the call and who have not yet uploaded their paper. And I know that they've sent me a paper. So David, we can give it like, you don't have to, you said you still have to give us some resources, which will be great, but I don't want to keep you here forever if they are.
No, that's all right.
Okay.
Yeah, I'm just putting some of them in
Okay.
the chat right now. So let me see. And some of these I believe you may have already shared, Professor Francis, with the students. So here's some. So the difference between a portfolio and assessment depositing, and then how to deposit an assessment assignment for students. There's also here just the general assessment resources through LaGuardia's ePortfolio website. So there it shows a rationale and kind of how to deposit it and what you need to know, right? I mean, ours is very simple and straightforward, but if you're, I know we spoke briefly about kind of the rationale for this, but if you're interested in kind of getting a further explanation of that, you're welcome to check this out. It breaks it down in a very sort of easy, digestible way, as well as shows you the technical aspect of it. And then the last thing is just kind of a plug for general ePortfolio support. As I know the semester is coming to a close. So there's different types of support that's offered by the ePortfolio team. They offer both in-person and virtual support, as I know that some of you may be going to school exclusively at a distance format, and some of you might be going in person, and perhaps you prefer in-person support and instruction, right? We all have our preferences. So I'm sharing just the homepage of the ePortfolio website that shows some of the support that they can provide both virtually and in person.
Thank you. And they have the reg hour now at 1 o'clock. Raphael knows that I told him that I'm gonna have you in here. So anyone who is again present in name and not in body or whatever's going on here, you have another opportunity to upload your term paper in the studio hour or the reg hour. And of course, thanks for these extra portfolio resources, because the class is also at the tail end of all the work that they've had to do for the portfolio, but they have some time to catch up on anything that's missing or to get help. So some of these resources will be helpful in that respect. Okay.
Excellent.
Thanks,
I'm glad to
David.
hear it. Yeah, you're very welcome. Thanks for having me, and
Yeah.
best of luck everyone with your finals.
Yeah. Okay.
Okay,
Have a good
take
day.
care. You
Bye.
too. Bye.
Thanks so much.
Mhm.
Thank you.
All right, everyone, thank you to those who did upload. There are a few people again on the call who haven't uploaded yet. Please do so during the reg hour. You have that reg hour now. As I said before, on the on Blackboard and in the class, you'll have until the 9th of December to just sort out the rest of your ePortfolio. But take the time now for the next hour between 1 and 2 to do some of that work. Are there any other questions for me at this moment before I let the call go? Before I end the call? Anybody, anything? Okay, so if not, you're dismissed. I'll stick around for another few minutes in case anybody wants to talk to me about something. I'm happy to hang around. I don't have office hours on Wednesdays, so I just want to make sure that I stick around for a few minutes in case you have other questions. Okay, have a lovely day. I'll see you on Monday.
Thank you. See you Monday.
Bye.